Okay, welcome back to the second part of this chapter. We majorly talk about the two knowledge points, which is learning objective 8 and 9. And learning objective 8 is a focus on impairment tests of the all the assets, right? And in our learning objective 9, we are talking about after acquire the company, you might have a different kind of like repairment or improvement costs, and how do we deal with that? Okay, so first of all, how do we calculating impairment value? What is impairment value? First of all, depreciation, depletion, amortization reflecting a gradual consumption of the benefits of the PP&E or any intangible asset. And an implicit assumption is that in allocating the cost of an asset over its useful life, that there has been no significant reduction in anticipated future benefits, right? Right. So therefore, there's no significant reduction. However, the situation can arise that cause a significant decline of or impairment of those benefits those PP&E or intangible assets can serve. For example, a building destroyed by a fire before the asset is fully depreciated, or then the remaining book value on the book, the asset should be written off as a loss, right? Because it's not the building, old building anymore, it's destroyed. And also you wanted to recognize and measuring the impairment loss depending on whether the asset are still to be held, to be used for, or being held for sale. There's two different. If you still want to holding the building just for the purpose and reconstructing it, the treatment of impairment is different from the if you wanted to sell that building. Okay, so first of all, we wanted to talk about the impairment for the value of the asset that you wanted to held and used. Okay. So there is an increasingly common occurrence in the practice that a partial write-down of property, plant, and equipment and intangible assets that remain in use. For example, in 2016, Murphy Oil Corporation recorded impairment charge of $95 million. The charge reflects the declining asset value associated with the lower oil and gas prices. And a write-down can provide an important information to the investor about the future cash flow that company can generating from using of its own asset. Even if a significant impairment of value has occurred, it is often difficult to measure the amount of required write-down. Okay. So hence that we wanted to know how do we make sure how much we should write down, when should we write down, right? And first of all, we wanted to introduce the PP&Es or finite life intangible asset. What are we going to do? According to GAAP, the assets are grouped at the lowest level for which the identifiable cash flow are findable. So basically, you wanted to identify which cash flow is generated by which asset. And then those cash flow are largely independent from cash flow from other assets. Okay, when you wanted to testing the impairment, the testing impairment only if event or changes in the circumstance indicate that the book value of the asset or asset group might not be recoverable. Okay, I will explain what is recoverable meant. But before that, we wanted to look at what kind of event can contribute into this kind of situation. So changes in circumstances that indicating the book value of the asset or asset group may not be recoverable might happen, such as a significant decrease in the market prices of certain equipment, a significant adverse changing in how the asset being used, or its physical condition, such as a flood happened to that a flood is soaked the equipment, or fire, or a significant adverse change in a legal factor or in the business climate. Like for example, the oil gas company find that the oil gas price decreased a lot, hence that the oil, the property, the natural resource of the gas and the oil field cannot generating as much as future cash flow because selling price is decreased, or accumulated of costs significantly higher than amount originally expected for the acquisition and construction of an asset, or current period loss combined with historical losses, or a projection of continuing losses associated with that asset, or a realization that the asset will be disposed of significantly before the end of its estimatable useful life, right? All these events will trigger people consider whether there is going to be impairment. And then how do we calculate impairment? There is a two-step. Step one is, first of all, make sure that whether the asset is indeed impaired. And then how do we judge it? And impairment occurs when the undiscounted sum of estimated future cash flow from an asset is less than the asset book value. So in other words, undiscounted cash flow is smaller than the book value. That means impaired, right? Step two is how much is impaired. So if it's impaired from first steps, then you will record impairment loss for the amount by the asset fair value minus the book value. And this fair value is discounted cash flow, okay? So you use undiscounted cash flow to judge whether there is an impairment. And then when you're recording the impairment, you use a discounted cash flow minus the book value, okay? If not impaired, then there's no loss to be recognized. Okay, so now I'm just further explaining what is a fair value here. So measurement, right? So if an impairment loss is recognized, the write-down of a book value becomes the new cost base for the future cost allocation, right? Because you impaired, hence that it's not recoverable anymore, you need a new base. And what the new base would be will be the fair value of the asset at the time of your write-down. And then what is the fair value? Fair value is the amount at which the asset could have brought or sold in a current transaction between willing parties. In other words, is how markets think about this asset right now, okay? But however, if a fair market value is actually not determinable because not everything has a price, right? Because for example, the kettle that you use for many years sitting on your stove, how much that's gonna exchanging for price for? It cannot sold as a new, and how much you wanna charge it. And then in that case, then you must estimate it. Hence, the fair value often is estimated as a discounted present value of a future cash flow. Let's look at this. So impairment and the cash flow estimation. The undiscounted estimation of cash flow are used to determine whether there are an impairment loss. And a discounted estimation of cash flow is often used to estimate the fair value to determine the amount of the loss, right? And hence that the disclosure notes needed to describe the impairment loss. The note need to include the description of impaired asset and asset group, the facts and circumstances leading to such impairment, the amount of the loss, if not separately disclosed on the face of income statement, and the method used to determine the fair value. Okay, so let's look at this example. The Dakota Corporation operates several factories that manufacture medical equipment. And near end of the company 2021's fiscal year, the changing in business climate related to competitors' innovative product indicated to company management 170 million book value, right? So, and then which is original 300 less accumulated depreciation for 130 of asset of one of Dakota's factory might not recoverable. So the book value of $170 million of an asset is not recoverable. And the because the competitor's innovation. And the management is able to identify cash flow from this factory and estimated that the future cash flow over the remaining useful life of a factory only be 150 million. Okay, this cash flow is discounted, undiscounted cash flow, right? And in other words, the fair value of the factory asset is not readily available, but it's estimated to be 135 million. So the fair value of the factory asset is $135 million. So what do we do now? First of all, we needed to see whether there's a needed to be impairment. So first of all, the recoverability test. We wanted to see the book values comparison to undiscounted cash flow, 150. And then because the book value is bigger than 150, hence that there is an impairment happens, right? So that means we need to book something. And second thing is the measurement of the impairment. We want to use the fair value, which is 135, minus the book value of 170, and we know there's a $35 million of impairment loss. And then what we do is, first of all, we recorded the debit the loss of impairment, and then we will credit out all the accumulated depreciation of 130 from the book, right? And then we're creating a new base, and then the new base needed the new factory has only book value of 130. So how do we reduce the factory assets from 300 purchase price to 135? We needed to credit out $165 million of factory assets. So therefore, 3 steps. Step 1, record the loss. Step 2, get rid of accumulated depreciation. Step 3, reduce the purchase price to the new fair value of the assets, right? Okay. And then let's look at if we have an indefinite life of intangible asset rather than goodwills. So we talk about the tangible asset with a definite life and PPE. We treat it as a recoverability test. And what if we have indefinite life intangible assets, right, such as trademarks? So what do we do? So first of all, we test for impairment annually and more frequently if it's necessary, or changing in circumstances indicate that it's more likely than not that asset is impaired. And a company has an option to first undertaking a qualitative assessment to avoiding quantitative tests. And also the measurement of impairment loss is a one-step shop, means that you don't need to do two. First step to see undiscounted cash flow minus the book value to determine whether there is impairment. Then use discounted cash flow to deciding whether there is gonna be how much it is the impairment. In this case, we only needed to value if the fair value is less than book value, then the impairment loss is definitely recognized, and there's no recoverability test. Okay, if an impairment loss is recognized, the write-down of the book value becomes the new cost base for the future cost allocation. So if you wanted to, this becomes the new cost for the asset. And then goodwill. Last thing we want to talk about, how do we testing whether the goodwill has impairment? First of all, goodwill is very unique intangible asset because goodwill is not exist without a company, right? Goodwill only attached to the acquired assets, right? Hence that unlike other assets, its costs cannot be directly associated with any specific identifiable rights or legal contract. And it's not separable from the company as a whole, right? Hence that because of these unique characteristics, we discuss goodwill separately, although conceptually the measurement of impairment for goodwill is as the same as all other indefinite life intangible assets. By its very nature, the goodwill is inseparable from particular reporting unit, hence the level of testing of recoverability is based on the reporting units. And reporting units is an operating segment of a company or a component of operating segment for which the discrete financial information is available, or segment of management regularly reviews the operating result of that component, such as, say, region, Midwest region, New York region, East region, West region of the company, or say specific geography area or specific product lines, right? We call it reporting units. And how do we measure the goodwill impairment? For the purpose of impairment testing, we want to compare the value of reporting unit itself with its own book value. If the fair value of reporting units is less than the book value of the reporting units, an impairment loss is indicated. And the impairment loss is the amount by which the fair value exceeds the book value. However, the recognized loss cannot be exceeded on the book value of the goodwill. Hence, that the book value is tested for impairment at the same time as other assets of the reporting units. The other asset must be tested first, and any impairment loss and asset write-down should be recorded before you consider the goodwill testament. And the subsequent reversal and recovery of goodwill is not allowed. Let's look at this example. So 2021, UPGene Corporation acquired Pharmacopoeia Corporation for $500 million. UPGene recorded $100 million of goodwill related to this acquisition. Because the fair value of identifiable net asset of Pharmacopoeia was $400 million, after acquisition, Pharmacopoeia continues to operate as a separate company and is considered as a reporting unit. At the end of the 2021, events and circumstances indicated that it is more likely than not the fair value of a Pharmacopoeia is less than the book value requiring. The UPGene perform a goodwill impairment test, and they find out the book value of a Pharmacopoeia's net asset is at the end of the year 2021 is $440 million, including $100 million in goodwill. And on that date, the fair value of a Pharmacopoeia is expected to be $360 million. Hence, the fair value of the Pharmacopoeia is $360 million. The book value of a net asset of Pharmacopoeia is $440 million. Hence, the impairment loss here is $80 million. And this $80 million will be a goodwill write-down. What we do is we were debiting loss on impairment of goodwill and crediting goodwill. Okay, we said that the asset held to be used and a keep is going to be treated differently for the asset held to be sold. But the impairment also can happen to the company who wanted to sell their assets. And this asset that management has actively commitment to immediately sell in their present condition, for which the sale is probable, right? And then also those assets could be, if the book value exceeds the fair value of the and less the cost to sell, and then we need to record the impairment loss. And remember, the asset held to sell or to be sold are not depreciable, okay, or amortizable, and it's being reported in a separate line of the balance sheet. And then now we wanted to talk a little bit about what's the relationship between the impairment loss and earnings quality. Okay, so an analyst must decide whether to consider asset impairment losses as a transitory in nature or as part of permanent earnings. So we now are adding the asset impairment losses to the list of the big bass accounting techniques some companies using to manipulating earnings by writing off a large amount of asset, and the companies significantly reduce the earning in the year of write-down, but are able to increase future earning by lowering futures depreciation, depletion, and amortization. Here is how. We measure the impairment loss as amount by which the asset fair value is less than the book value. However, in most cases, okay, the fair value must be estimated, and the estimation process usually involves the forecast of a future net cash flow and the company expects to generate from asset life. If a company is underestimated, okay, underestimating the cash flow, so in other words, By writing off a large amount of assets, the earnings are significantly low in the year of write-off. However, due to your write-off, the base of the new asset, the new base of the asset will be so low to extent that in the future it will be reduced. The depreciation expenses will be very low, and depletion and amortization are very low. Hence, that you can boosting the net income in the future years, right? On the other hand, if company underestimated the future net cash flow, hence the fair value is underestimated. That means the fair value could be always bigger than the book value. And then two effects of underestimating fair value, right? That means the current years. So if you underestimate the fair value, that means that you are more likely to have impairment recording, and then that means the current year's income is unrealistically low due to the impairment loss, right? Because you always underestimate the future value, and then you always have a recovery test as positive, and then hence that you write down a lot, right? Once you do that, the write down year, you have a very low income. But the future income is unrealistically high because the base is too low, hence the depreciation, depletion, amortization is gonna be understated for the future period as well. Okay. So that means that impairment is such interesting tricks that management use trying to manipulating earnings in current period and influence the future period. Okay, we call that take a big bath. Meaning that if I'm not doing well this year, why don't I just write down as much as I can? Helpful in the future year, I will have a big wins, right? Because in the future year, I will have so many reduce the cost that I needed to allocate. And then now I wanted to talk about the learning objective 9, which is second part of this lecture, which is that how do we deal with expenditure happened or subsequent to acquisition. And then, so many long-lived assets requires expenditure to repair, maintain, or improvement after their acquisition. The expenditures that produce benefits beyond the current physical year should be capitalized. And then, in other words, we wanted to increase in the net asset. However, the expenditures maintained at a given level of benefits should be expensed in the period they are incurred. In other words, we wanted to capitalizing those subsequent expenditure when it's increasing the asset book value or creating a new asset, and we were expensing it when it's maintaining the given level of benefits. And then, in other words, there is a judgment here. If you see the expenditure is increasing the future benefits of asset, means that either extension the useful life of asset or increasing the operating efficiency of the asset, such as increasing the quantity of the goods produced or decreasing the future operation costs. Or third, the expenditure is increasing the quality of the goods and services produced. This all considered can be capitalized, right? Considered as a future benefits increase. But before we consider whether there is a future benefit increase, we should assess materialities of those spending, right? So many companies set materiality threshold for the capitalization of any expenditures. So regardless whether it's the future benefits increasing or not, you have to pass that threshold, right? For example, a company might decide to expense all the expenditure under $1,000 regardless whether there is a future benefit or not, okay? Okay, once you pass the materiality threats, then we consider whether it's increasing future benefits or not. First of all, we wanted to introduce what kind of expenditure should be expensed, right? First of all, repair and maintenance expenses are expensible because repair and maintenance is made to maintain a given level of benefits provided by asset. It does not increase in the future benefit in the way that we described. and future benefits are not provided beyond those originally anticipated. And the expenditure for this activity should be expensed immediately in that period. The example of repair and maintenance costs, such as an engine tune-up or repair an engine for delivery truck, allows the truck to continue to be productive. If the maintenance is not performed, the truck will not running anymore. Hence, that the maintenance itself only to providing original expected function, right? And the future benefits are not increased, right? Hence, that those kind of maintenance repairment costs can only expensed. And then another one, the second category is we wanted to capitalize. The reason is that we wanted to add addition something on top of it. Addition means adding a new major component to an existing asset should be capitalized because the future benefits are significantly increased. Example, like adding a refrigeration unit to a delivery truck can increase the capability of the truck, thus increasing the future benefits. And the costs we can capitalize are including all necessary expenditure that are required to bring it to its condition to use or location for use. For example, for building addition, this might include costs of tearing down or removing the wall of existing buildings. And then second category of capitalization is called improvement, right? It involves replacement of a major component of asset. The replacement can be considered with two ways. You replace with a new component with the same characteristic as old, or you can replace it with an enhanced operating capability. In either cases, those costs of improvement can increase in future benefits, and hence it should be capitalized by increasing the book value of the related asset and be depreciated over the useful life of improved assets. Example, an existing refrigerator unit in a delivery truck could be replaced with a new but a similar unit with a new and improved refrigerator units, right? So the method used to record the cost of improvement has three different kinds. First, if you treat it as a substitution, we do different accounting treatment. If you wanted to consider it's the new part of cost towards on top of the old asset, we treat it differently. We call it new cost. Or you can treat it as a reduction of accumulated depreciation for the old machine or old refrigerator. Let's look at the three different methods. Substitution method, the treatment, how do we accounting do it? First of all, if it's a substitution, that means we wanted to get rid of the old machine and then we want to record a new machine as a new component. Second, if you want to capitalize the new costs, what we do is that the cost of improvement is included as a debit to the related asset account, such as debit refrigerator -new, and then the original cost and accumulated depreciation of original component are not removed. So you keep the book value of the old state, right, intact. And then acceptable only if this condition acceptable only if the book value of original component has been reduced to an immaterial amount through prior depreciation. That means that the refrigerator has been almost used in the end of the life, and then when you improve it, you replace with a new refrigerator, then you can do this treatment. And then the third choice is that you can do is to reduce the accumulated depreciation of the old. So the asset account is left unaltered, but its related accumulated depreciation is decreased by the amount of new component. The book value is the same as in capitalization of cost method, but the cost and accumulated depreciation amount both differ under the two methods. So I will introduce you one by one. So let's look at this example. If we treated the improvement as a substitution situation. Okay, Palmer Corporation replaced air conditioning system in one of its office buildings. that leases to the tenants. The cost of an old air conditioning system was $200,000, is including the cost of the building. Okay. However, company has a separately depreciated air conditioning system. The depreciation recorded up to the date of replacement the total $160,000, right? So the depreciation, so now the book value of the air conditioner is only $40,000. And then the old system was removed and a new system installed at a cost of $230,000, which is paid in cash. The part of the old system was sold for $120,000. So in terms of substitution, we wanted to first get rid of the old and then second record the new, right? So hence how do we get rid of record? We needed to recording cash that's received by selling it, and then we debit out all the accumulated depreciation of the building, which is building means the air condition, and we credited out the old building, right, $200,000, and then we recognize that there's a loss on this disposal of $28,000. And then we're recording the new building, which is debiting the new cost of $230,000 and crediting out in cash. This is the substitution. How do we record a substitution? And second way of treatment of the improvement is to capitalize the new cost, right? How do we do that? The same scenario, if we want to treat it as a new cost, all we need to do is to make sure that we capitalize the new cost by debiting $218,000. How did I get that $218,000? Is equals, because the capitalization, the building is debited $218,000 is equals to $230,000 minus the cash we received from the sale part of the old asset, right? Since cash is paid for the purchase of a new building of $230,000, and the cash of $120,000 is also received from sale of the parts of the old system. Hence, that the net cash outflow should be $218,000, right? Okay. So in other words, the new building, the building you are adding on top of a $230,000 of new building, but you have to minus the $12,000 of cash that you received. Okay, so that's how we calculating 218. And then if we wanted to choose the third method, which treated as a reduction of accumulated depreciation, what do we do? Same thing. We wanted to reduce the accumulated depreciation of the old building by $218,000 as well, which the reason is that the book value is the same as a capitalization method, but the cost and the accumulated depreciation might differ, is because accumulated depreciation should only debiting $218,000 because you spend $230,000 to adding a new building, but you also received $12,000. So hence that the net spending on the new should be $218,000, right? And hence that the cash is the same thing. Cash is gonna be credited out $218,000. And then this is part to reduce the building's accumulated depreciation. Okay, so last situation of expenditure made to reconstruct or restructure an asset without addition, replacement, or improvement, we call it the rearrangement. Okay, it's money that you spend to reconstruct the asset, but it's not the addition, it's not replacement, it's not improvement. And the object of rearrangement is to creating a new capacity of the asset, not necessarily extending its useful life. The example is that the rearranging of machinery on the production line to increasing the operation efficiency, or relocate the company's operating plants or offices of the building. So rearrangement, here's the thing. If rearrangement expenditure are material, then we wanted to capitalize it because it indeed can bring future benefits. But if rearrangement cost is immaterial or is uncertain how much the future benefit can bring, and then we should expense it in the periods occurred. And then the last thing I want to talk about is if you're spending money to defending your intangible assets, such as infringement of copyright, if that defending expenses, the litigation cost is successfully defended the intangible assets, that means you should capitalize it and amortize it over the remaining life of the assets. If the intangible rights is unsuccessfully defended, that means that litigation cost has to be expensed immediately as incurred because they're providing no future benefits. And the book value of any intangible asset should be reduced to realizable value at that point. Okay, we finished chapter 11, and then this will wrap up our last lecture of this semester. And it has been a great semester with you guys. And I enjoy teaching you, and I hope all this pre-class video recording can be helpful for you in learning. And I will see you guys in the class. Thank you very much.